Thank you very much, Richard, and it's great to be here. Can everybody hear me at the back? Excellent. I've got a very important topic to kick off on, and is there long-term value? I think most of you are very much interested in that topic and want to get clarity on that. And I'd just like to, before I begin, to thank SIS for allowing me to present in front of such a large audience today. Now, let me just see if I can get this working. All right, we'll use that. That's fine. Thanks. The key thing is many investors today are still very much worried about volatility. They're worried about what the macro is doing. They're worried about what's going on in the US. They're worried about what's going on in Europe with the ECB and the debt crisis. They're worried about China with the slowdown there and the overhang of the property market. And many investors are holding cash. The problem with holding cash, though, is that your return on cash is only around 25 basis points, less than 0.5%. Inflation, on the other hand, as Richard was alluding to earlier, is around 4 or 5%. So every year, you're going to lose money. And I think that's very clearly highlighted by this chart behind me. What it's highlighting there is that if you had $1 million back in, I guess, 2000, today it would only be worth around $800,000 to $850,000 in terms of what it can actually buy you, whether that's property, whether that's equities, whether that's gold, actually less than gold. Most other commodities and hard assets have actually gone up over the last 10 years relative to cash, which has gone down in terms of its purchasing power. So that's actually very critical. Now, many investors that we talk to, they say, yes, that's fine, but I want to hold cash right now because the environment is so uncertain. We're very concerned about the environment. The reality from our side is that we actually think the environment is going to be a muddle through. So we allocate a 70% probability that we'll muddle through this environment. And many investors out there in the market are talking about a muddle through as well. On the one hand, you have inflation, which is highlighted by the global recession. We allocate a 20% probability of that. That's deflation with issues of crisis occurring in both Europe, increasing slowdown in China, and then the Fed dealing with its fiscal cliff. And on the other hand, we have strong growth. But in the middle, you have the muddle-through environment. And the muddle-through environment is actually quite good for many asset classes. Now, the question there is, well, how does one invest through this muddle-through environment? And when we talk about muddle-through, we obviously are concerned about growth, but at the same time, we see longer-term strong performance with volatility. So we have a strategy called VVIP. V for value, V for volatility, in the sense that you're going to get the market going up and down. We've seen that in the equity market, we've seen that in the commodity market, we've seen that in the gold market. A lot of volatility, a lot of uncertainty. I is for inflation. We already have around 4 to 5% inflation in Singapore. The central banks around the world are trying to promote inflation with very low interest rates. The interest rate in the US, for example, the benchmark rate, is around 25 basis points, extremely low. And the Fed has promised that it's going to remain low for another 2 to 3 years. So inflation has to be one of your concerns longer term. P, get paid for taking your risk. What do we mean by that? We mean buy those assets that as you hold them, you get paid for holding them. So that means high dividend yielding stocks, and it means high yielding bonds. And I'll go into a little bit more detail on that later on. Now, how have we done? With all this worry and muddle through environment and concern about recession and all the rest, within our VVIP strategy, we've actually done quite well. So we are overweight equities. And if you look at the chart behind me, US equities is our preferred market. It's up around 13% year to date. So we're not even through the year, but it's up around 13% total return. Equities as a whole are up around 10%. And then, as I was mentioning, the high dividend yielding corporate equities, which we like as well, up around 7.5%. And high yielding bonds up around 12%. So there are many asset classes out there, as we've highlighted, bonds, equities, and commodities that have generated double-digit return, whilst the cash in the bank is only generating 0.5%, if that, if you're lucky. Now, the issue is, investors still push back and they say, well, that's great. I'm happy the market has gone up, but I'm concerned about what's going to happen tomorrow. I'm concerned about what's going to happen over the next 6 months. And the reality is you're better off as an investor always having some allocation to the various asset classes. You're always better off having some allocation. What we highlight here in the chart behind me is that if you had 10,000 invested for the last 30 years in the S&P 500, the US stock market, by 2008, so we're talking about a 30-year period, if you'd had that invested all the way through, you'd have 93,000. If you'd missed some of the trading days, missed some of the best trading days, you'd either have 61,000, 46,000, and if you had missed 50 of the trading days, you'd only have 9,000, a little less than the starting amount. The point of that is market timing is extremely difficult. It's extremely tough to say, I think the market is cheap right now, I'm going to buy tomorrow, and I hope the market will go up, because the market may actually carry on going down. Likewise, there could be a lot of momentum in the market, and you could say, I think this market is going to go up, you buy, and the market actually goes down. The point is, market timing is very difficult, and it's better to have cash invested in the market all the time. And as you're earning, as you're building up your businesses, you should always be taking a little bit of what you earn and putting it into the market. And I'm not suggesting here that you invest all of your savings in equities or commodities or in gold. What I'm saying is diversify, have a little bit of cash, and good exposure across different asset classes. So what do we like in this environment? Equities is our preferred asset class. And I'm not going to sing it to you, but I'm sure you all know the song, Better Than All the Rest. Equities are cheap. And if I could highlight this with my little, yeah, here we go. All right, you can see the little green dot over here. What we've done is we've highlighted the price to book of the various markets. So the large rectangular box is effectively the range of price to book. The earlier speaker was highlighting that price to book is one of the tools that you can use, or one of the metrics that you can use for analyzing the valuation of equities. So, for example, Asia ex Japan, this is the range, this is the median, the average, the little rectangular horizontal line, and this is where we are today, the little triangle. So you can see, for example, if I just step to the side, you've got the world, which is actually very cheap. It's towards the bottom end on the price to book. You've got North America, which is also pretty much at the bottom end here, well below the median. You've got Europe, which is well below, and you've got Japan, which is very, very cheap on a price to book basis. What am I trying to highlight here? That equities, relative to their own history, are fairly cheap. We highlight this again for some of our preferred markets. So we've got up at the top here, US, Europe, Korea, China. These are the markets that we are overweight or neutral on in the case of Europe. And what we highlight here is the price to book over the last 8 years, pretty much. And the price to book has obviously increased in 2007, declined 2008 and 9, and is now around about over here. The point of all of these charts is, again, to reiterate the fact that on a price to book basis, and the same is true on a price to earnings basis, most of these markets are very, very cheap relative to their longer term history. And just to bring it closer to home, because I know many of you will have exposure to the Singapore market is fairly valued. It's cheapish, not as cheap as the rest. We're neutral on the Singapore market right now. We do like some areas within the market. We think some of the banks, for example, are quite cheap. We think some of the oil companies are quite cheap. But generally, the market is a little bit more expensive than some of the others we look at. Now, the other comparison you can make is, well, how do equities compare with bonds? There's always that comparison in terms of, should I buy bonds, should I buy equities? The reality here, again, is that on most measures, when you look at the bond yield versus the earnings yield, which is E over P, it's just the reverse of PE, equities are very cheap against bonds, against their longer-term history. So that's another indicator that we should be overweight equities. That's all very good and fine. We're overweight equities. We like the equity market. So how do we invest in the equity market? As I highlighted, we like the US, we like China, Korea. We're now neutral in Europe. And we signed some very good value in the dividend-yielding stocks. Our preferred stocks are what we would call defensive, high-quality companies that have high dividend yields. And there are many of these companies across the US, Europe and in Asia now. If you look at the Asian markets, for example, and even the Singaporean market, there are companies that are yielding well over 5%. That means that if the company share price remains flat, but the yield is 5%, you're going to get 5% coupon on that share every year. So the more defensive the company, the better, because it simply keeps on going and keeps on paying over those dividends. And there are many REITs in Singapore, for example, that are yielding over 5%. Some of the banks are yielding over 3.5%, 4%. And in the US, the same sort of situation is true. So we like high dividend yield, as you're getting paid for holding the risk of taking exposure to equities. Commodities, gold and oil. Now, it's difficult to say that gold is cheap right now. It's not cheap. Gold was cheap back in 2000 when it was trading at around $250 US. Gold right now is trading at around 1,650 US dollars. So it's not cheap. So the other question is, well, is it in a bubble? And we'd probably say, no, it's not in a bubble, because we haven't seen that parabolic rise yet that you typically see in a bubble-type environment. Likewise, if you look back at the 1980s, for example, when inflation was over 15% in the US and investors were chasing gold, investors today are not chasing gold because of inflation. They're chasing gold because of the concern over future inflation. But inflation today is not that high globally. In the US, it's only running at around 2%. So gold, we do not believe, is in a bubble phase right now, but neither is it cheap. So you have to be quite careful with gold longer term. What we do like about gold, though, and you can see it very clearly here, the blue line is the market, the SPX, the S&P 500 for the US. So back in August 2011, last year, we saw that decline quite substantially. Gold, on the other hand, rallied. Same sort of thing is true here, here, and over here, for example, you can see again the negative correlation. Why do we like that? It means that by holding gold and equities, you get nice diversification of your assets. If equities go down, hopefully gold goes up. If gold goes up, equities may go down, or equities up, gold goes down. So you get a nice diversification of your assets, and you're holding two asset classes that we like, because there is value in equities, and longer term, there's value in gold, given what the central banks across Europe and the US are doing. In that respect, it's quite important to highlight here that central banks, these are the gold reserves by central banks, they dropped off substantially throughout the 70s and then all the way through to, I guess, 2000 when the UK was selling its gold. And they've now started to rise. So you actually have record levels now of demand from many of the central banks in Asia, in India and China and other parts of Asia, buying gold. They want to diversify away from the US dollar, and they're now buying gold. And that is obviously a key driver for us. The other highlight here is that you have ETFs. ETFs in gold were launched around 2000, 2002. It allows investors such as yourselves to buy into gold very easily. You can do it through the ETF, and that's driven demand for gold at the retail level. So that's a key driver as well. And then also what we highlight here is the Fed. The Fed is obviously providing enormous liquidity to the market. They've done their QE1, they've done QE2, there's now concerns about QE3, and that's obviously very positive for gold. And you can see the relationship here between the Fed's balance sheet, the green line, and the blue line gold. Very high correlation. So if we do get QE3, and then possibly QE4, whether that's at the Fed level or at the ECB level, that is very positive for gold, according to the correlations that we've seen. Oil. Again, it's difficult to say that oil is cheap, trading at around 120 US dollars in the case of Brent. It's not cheap. Even if you adjust oil for inflation, it's not that easy to say it's cheap. The key driver with oil, though, is the fact that you have limited supply, and that supply is held by what we would call fairly unstable countries. Obviously, in the Middle East, there's geopolitical tensions. That could be a positive factor for oil. And the other key driver is obviously China. China demand for oil is significant. This is the top chart up here. So this is their demand for oil in terms of, I think it's probably tons of oil, millions of tons. China is going through a boom phase. People are buying cars, They're buying goods. Those goods need to be transported by trucks, et cetera, et cetera. So the demand for oil is going to continue increasing in both China and India. And the current per capita consumption of oil in China and India is way below that of the US. So even if we go halfway to getting up to sort of US levels or European levels, that demand is going to put massive pressure on the price of oil going forward. So very, very key. The other thing, obviously, is that holding oil or having exposure to oil stocks gives you a great hedge against geopolitical tensions in the Middle East. So we'd always recommend having some exposure either to oil, the underlying commodity, or to the equities. And I would say on the equities side that the equities are very cheap. On average, they're trading at below 8 times price to earnings, and they're yielding around 5%. So we like the commodity, and we like the equities as well. Bonds. I'm only going to show you one chart in bonds. We like high-yield bonds. We don't like bonds that are issued by sovereign governments, such as the US, Europe, or Japan. We don't like those bonds. We like corporate credit, and we like high yield. And in the case of high yield, for example, you can see here, this is the spread against sovereigns, and you can see that the spread is around 6%. So you're still getting a nice yield of corporate bonds, of high yield. What we would say, though, in the case of high yield, is that you have to be quite careful in terms of the companies that you hold the bonds of. Right? You don't want to just buy high yield per se. You want to make sure that you're getting the right companies and the right bonds. Companies that will survive, companies that can continue to service their bonds longer term. I was highlighting earlier on the need for diversification. I mean, I've highlighted here that there's a lot of value out in the market, given all this fear factor, but you still need to be diversified. I think this is actually quite a good chart. What we've got here is we've got the annualized return of different asset classes. So you can see the green over here, actually we've got 2 greens unfortunately, but the green over here is 100% equity. And you can see the return over here. This is the return from 2009 through to 2012, so roughly 3 years. The blue is equity plus 40% bonds. And then we add in some gold as well. So the point here is that if you add in bonds, 40% equity, 40% bonds, 60% equity, 40% bonds, the return is actually slightly higher. That's pretty interesting. The return is slightly higher if you add in those bonds. What's more interesting for us, though, is your volatility goes down. So this is the only equities line, and this is the volatility of holding bonds and equities. And here we've added gold as well, which takes the volatility down a little bit further. So on a 50% equity, 40% bonds, and a 10% gold, you get the lowest vol, and you actually get very good returns relative to holding pure equities. Why is that important? We all like to sleep at night, don't we? None of us want to worry about whether our equity is going up or going down, or what should we do? It's gone up 10%, should I get out? Or it's gone down 10%, ooh, should I get out? What we want to get clients and investors proactively engaged with is the idea that they hold a nice portfolio of stocks. So you should have at least 20 to 30 equities, not just in Singapore, but they should be diversified across all of the global markets. You should have a little bit of gold, you should have some bonds, you should have some commodities, and when one goes up, the other goes down, most likely. But generally, over a period of 1 year to 2 years, you should start generating outperformance. That's what you're wanting to generate, longer-term outperformance against cash. Because at the end of the day, holding cash, it's a losing game. So in terms of how we would actually allocate our funds, we're overweight the US, we're overweight equities, as I mentioned. We're neutral on Europe, underweight neutral on Asia ex-Japan, underweight Japan, and underweight other EM, and then overweight commodities. And I think this is actually quite an important column for you here. The moderate allocation that we would recommend to clients is shown here. So in the case of equities, for example, it totals up around 38%. So around 38, 40% of your NAV, your investable net asset value, should, in our opinion, be invested in equities. The rest would be invested in bonds, and the rest would be invested in commodities down below. So around 15% in commodities as well. And I think my time is sort of running out, so I'm going to leave it there. But just a quick advert for SCB in terms of what we do. We put out a lot of documentation to our clients, and every month we do a review of all of the asset classes, whereby we review our overweights and underweights. We also do a weekly. We do a lot of work on the equity side as well, where we look at different stocks and different ideas. And we also do FX strategy, commodities as well. So we basically cover all of the various asset classes out there. And obviously the detail is much greater than what I've been able to give you in the last 30 minutes. But just as a sort of review, cash is good to hold short term. It's always good to hold a little bit of cash, but longer term, cash will go down in value, number one. Number two, there is value out there. Equities are relatively cheap. We like the high-yielding equities. We like the defensive plays, but there will be a lot of volatility. So you need to be prepared for that. If the markets do go down and there is a lot of volatility out there, we would want clients not to have leverage to the markets, but to be able to actually take exposure, to increase their exposure to those markets and take advantage of the sell-offs that we see. Hold a little bit of gold, hold bonds, but preferentially the high-yielding corporate bonds, and take a little bit of exposure to oil as well. And I think I'm going to leave it there. And thank you very much. Appreciate it.